Hello guys, let us do IS 19, that is employee benefit. So we are going to talk about what's the meaning of the word employee benefits. Then we identify the categories of the employee benefits. Then we do recognition and measurements. And then we also do a question from our past paper. So let us welcome. So welcome. And let us start. So welcome. Let us start. This is IS 19, employee benefits. So let us see some of items here on the board. So we have the employee benefits, and we have said that the employee benefits refers to the all form of consideration given by the entity in exchange for the service rendered by an employee or for the termination of the employment. So that is the meaning of the word employee benefits. So those are the consideration or the benefits that an entity or an organization exchange for the service. Examples of those benefits are, for example, the salaries, the social security contributions. We have paid annual leave or paid sick leave or bonuses. Now, the standards applies to employee benefits under the following. Number one, the formal plans and agreements between the entity and the employee. We also have the national or the state, that is the government, and the industries and the multi-employer plans. We might also have the informal practices that give rise to constructive obligations. Now we have categories of the employee benefits. We have five of them. So one of the first one is the short employee benefits. But we have the post employment benefits. Then we have the other long-term benefits. Then you have the termination benefits and the equity composition benefits. Now let us see the short-term employee benefits. Short-term employee benefits. These are those benefits which are there for a limited period of time, less than 12 months or less than an year. So short-term employee benefits. So these are the benefits to be settled. So the entity must settle this benefit in less than 1 year or in less than 12 months after the employee has rendered or has provided the service or in a situation where the employee has already undertake the service. So examples of the short-term benefits or the short-term employee benefits are the wages, salaries, the social security contribution, the paid leaves, it can be and the paid sick leave. Then you have the recognition. So how does the entity recognize and measure the short-term employee benefits? So the IS 19 requires entities to recognize the undiscounted amount. Remember, this amount is undiscounted. It has not been discounted because it is within the year. So the entity requires the entity to recognize the undiscounted amount of the short-term employee benefits. Number one, as a liability, that is in the balance sheet, meaning a liability as an accrued expense. An accrued expense in what does it mean? It means that the amount has not been paid. So that is after deducting the already paid amount. So the amount that it is not yet paid, it's a liability to the entity, and therefore it's an accrued expense. And also, the unpaid amount shall be recognized as an expense in the income statement. That's number one. Number two, we have the post-employment benefits. And for the post-employment benefits, these are the benefits paid after completion of an employment or after retirement, mostly. We can also talk about the retirement. So when a person retire, then that will be the post-employment benefit that they get. For example, post-employment medical care or the post-employment life insurance. So you can have post-employment or the retirement benefit or pension. So you can talk about for the post-employment benefits. We can talk about post-employment benefit. You can talk about pension. Pension is one of best example of the post-employment benefits. That is after employment. So when you retire, or you can also talk about the post-employment life assurance, post-employment life insurance, and post-employment uh, medical care. Medical care. So those are examples of the post-employment benefits. Now let us see the types now. So what are the types? So we can have three types. The first type is the defined contribution plan and the defined benefit plan. So defined contribution plan and the defined benefit plan. So defined contribution plan and the defined benefit plan. Then we have the state plan. Then we have the insured plan. The insured plan, or we call them the multi-employer plan. So this insured plan, you can also call them the multi-employer plan. Multi-employer plan. Multi-employer plan. So so A and B. So for A, not A and B, rather than B and C, supposed to be B. This B, state plan and the insured plan. State plan and the insured plan, they are multi-employer plan. So they are categorized as multi. They are categorized as multi-employer plan. Let's start with the first one, defined contribution plan. Let's start with the defined contribution plan. Once we finish the defined contribution plan, we shall go to the defined benefit plan. Then we talk about the state plan, then the insured plan. So that's the defined contribution plan. Defined contribution plan. So what is it? So the defined contribution plan is any plan under which an enterprise or an entity pays a fixed contribution into a separate entity, into bracket fund, or into a separate fund. You can call it a separate fund or separate entity, whichever word you want to use. So it's any plan under which an enterprise pays fixed contribution into a separate fund, and employers legal or constructive obligation is limited to the amount that it agrees contribute to the fund. So that is what we call the defined contribution plan. So this is where an enterprise pays some amount into a particular fund, and the employer constructive obligation is limited to some amount that they have agreed. Now, under defined contribution plan, the employee has the following risk, or might incur or might fall for the following risk. Number one, we have the actuarial risk, and number two, we have what we call the what the investment risk. So actuarial risk and investment risk. I think that one is fine. So before we continue, what do we mean when we say actual and investment risk? Actual and investment risk. So what is the meaning of the word actual and the investment risk? Now, when we talk about the actual risk, Not actual, it's supposed to be actuarial. Actuarial risk. It's supposed to be actuarial risk. Actuarial risk. So actuarial risk and the investment risk falls on the employee. Falls on the employee. Now, what does it mean when you talk about the actuarial risk? Now, actuarial risk refers to the benefit being less than expected. So, actuarial risk refers to the benefit being less than expected. So, when we talk about actuarial risk, we mean that the benefit being less than the expected. So, you find that the benefit that you expect is not what you get. When it is less than what you expect, then it will lead to what we call the actuarial risk. Then we have the investment risk. The asset investment being insufficient to meet the expected benefit. So we talk about the investment risk. So it refers to the risk that asset invested, asset invested will be insufficient, will be insufficient, will be insufficient to do what? To meet expected benefits. To meet expected benefits. To meet the expected benefits. That's what we need to know. So that when we talk about the actuarial, the investment risk, actuarial risk refers to the risk of the benefits being less than the expected, and the investment risk refers to the risk of an asset invested will be insufficient to meet the expected benefits. That's the recognition and measurement of the contribution plan. Recognition and measurement of expected plan. So what are the recognition? Now IAS 19 requires entity to recognize the contribution payable to a defined plan in exchange for the service by an employee during the period, number one, in the balance sheet as accrued expense, just the way we said it here. So if it is not being paid, then we shall recognize it as an expense and also as a liability in the balance sheet. So accrued expense is a liability in the balance sheet after deducting the amount that has already been paid. So any unpaid amount shall be recognized as a liability. Number two, if prepayments exceed the contribution. Now, if the prepayments exceed the contribution due to the service before the balance sheet date, the excess shall be recognized as an asset. So remember, prepayments are assets. So any excess to the contribution shall be recognized as an asset. So any prepayment which exceeds the contribution shall be recognized as an asset. And then in the income statement as an expense. So that expense is what we are talking about, the accrued expense. So this accrued expense shall be recognized as an expense in the income statement. But remember, the same accrued expense shall be recognized as a liability in the balance sheet. Now, the amount of contribution, remember this, when we talk about the post-employment, this one is even after 1 year. It is more than 1 year. So it is the post-employment in the retirement, during the retirement of a person. Now, when we need to do that amount must be discounted back to the present value because it's the post-employment. It must be discounted to the present value to get the exact amount today. Now, the contribution should be discounted if due more than 12 months. So we need to discount them from the future to present if they are due in more than 1 year. And we shall discount them using a discounting rate that is determined from the market yield at the balancing date, at the balance sheet date. And remember, based on what? Based on corporate and government bond. So based on corporate and government bond. So if they ask you an exam, which rate is used to discount the post-employment benefit plan, then you shall say it's a discount. It's a rate that is determined from the market rate using the appropriate government or corporate bond as at the balance sheet date. Let's see the defined benefit plan. Defined benefit plan. So defined benefit plan is any employment plan other than the defined contribution. So other than the defined contribution, that's the definition. Now they can be funded or unfunded. So the plan can either be funded or they can also be unfunded. So when they are funded, it means that it is being funded by the employer or by the employee. So by making contribution to the entity or to the fund that is legally separate from the reporting entity. Now, we see under defined benefit. Let us continue. Still under defined benefit plan. Still under defined benefit plan. We continue. So let us see the continuation of the defined benefit plan. So continuation of the defined benefit plan, and we had already defined what is called defined benefit plan. So what I wanted to talk about defined benefit plan, an addition is the recognition and measurement. So I want to add on the recognition and measurement. Now, before we go to the recognition and measurement, you need to know that accounting for the defined benefit plan is more complex compared to the defined, the other one, the defined uh, contribution plan. So the defined contribution plan. Now, this is because actual technique and assumptions are employed to measure the defined benefit plan and expenses. So in this case, we shall use the assumptions and the actuarial techniques. Now, uh, so there are also there is also possibility of actuarial gains and losses. So there is so we talk about the defined benefit. Remember, for the defined contribution plan, there is no actuarial gain or losses, but in this case, there is possibility of the actuarial gain or losses. The assumption might differ from the actuarial outcome. Now, these obligations are measured on a discounted basis because they are future figures. Because all those obligations they are future, and we need to discount them because they may be settled many years after the employee has rendered the related service. So those obligations be they might occur in the future where the employer has already rendered the service, and therefore to discount them to present value, then it means we need to discount them. Let us see the recognition. Now IAS requires, so IAS 19 requires entities to recognize in the balance sheet the net total of the following defined liability. Number one, the present value. So this is what it means. So the defined, we say defined liability, defined liability, defined benefit liability, defined benefit liability as is equals to the present value. So you need to recognize that one. So you add actual gain or you less actual gain, or it can be a loss. So you start with the present value of the defined benefit obligation. That is the gross obligation before deducting any fair value of the asset. Then you add or you less the actual gain or actual loss, not recognized, using the corridor approach. Then you minus any service cost, past service cost, and then you minus the fair value of the balance sheet date of the plan asset, out of which the obligation are to be settled directly. So that's what you need to know. So that's the amount that we shall recognize in the balance sheet. So the defined benefit liability will be equal to the present value. You add any gain or loss. You either add or you less the actual loss or gain minus the past service cost minus the fair value at the balance sheet date of the plan asset. Now, if the value that you obtain above this value, it is negative value, then it means it's an asset. So if you obtain a positive value, sorry, if you obtain a negative value above, so remember this one is a liability. So, but if you obtain a negative value, the resulting asset is recognized in the balance sheet and should be the lower of the following. Number one, the net total calculated, the net total, that the net total is the net negative value, or the net total of the following: the actual gain or losses in the past service and the present value of the economic benefit. So whichever between the two, which shall be the lower of, we pick as the asset. Now, let us see the items that we shall recognize in the income statement when we talk about the IAS 19. Number one, the current service cost as an expense. Number two, interest cost as an expense. Number three, gain or loss on the curtailment or the settlements. We can also call them the any effects of the curtailment. So that point and this one is similar. So any effects to the curtailment or the settlement of the defined benefit, those are the gain or losses from the curtailment or the settlement, which arises from this defined benefit plan. Then you have the expected return from any plan asset. So any return from the expected asset or any reimbursement right shall be recognized as an income in the income statement. Then the actual gain or losses to the extent that they are recognized shall also be recognized in the income statement as an income or as a loss. Then any past service to the extent that it is required to be recognized. So up to which up to a particular extent shall be recognized as an expense. Now let us see the recognition of the actual gain or losses, the corridor approach. Now actual gain or losses arises because actual outcome or the current forecast differs from the forecast made in the previous period. So this actual gain or losses might arise because of this reason. The differences which arises between the actual outcome and the previous forecast that was made. So they may arise from the changes in the present value of the defined obligation or the fair value of the related plan asset. Now, IAS 19 does not require the immediate recognition of the actual gain or losses. It does not require the immediate recognition unless there is fluctuation in them. So in them are so great. So IS 19 does not require the immediate recognition of the actual gain or losses unless the fluctuation in them are so great that the deferral is not deemed appropriate, and therefore the corridor approach is used. So and therefore corridor approach will be used. Actual gain or losses might offset each other in the future or in the long term. Now that is all about the defined benefit plan. So we had a type of benefit plan. So we started with the defined benefit plan and the defined contribution plan. We also talk about the short-term employee benefit. So number four, let's talk about the long-term employee benefit. The other long-term employee benefit, other long-term employee benefit. Then we shall remain with once we do this one, we talk about this one. We shall remain with the other two. That is the termination benefit, and the other one was the equity compensation benefit. Equity compensation benefit. So let's see the other. So this include long-term services rendered, long-term service or sabbatical leave, profit sharing and bonuses payments payable 12 months or more. So this the long term, it must be more than 1 year after the employee has rendered the service. So it can be the long term service or the sabbatical leave. Now recognition is the same as those of the post employment. So if they tell you to explain the recognition of long-term employment benefit, you shall explain the same as those of the post-employment benefit, as those of the post-employment benefit. Now, actual gain and losses and all past service costs are recognized immediately, and the code approach is not used. So we do not use the code approach. The code approach is only used under defined benefit plan, and only where we have the actual gain or losses, where we have fluctuations. No, but in this case, actual gain and losses and the past service costs are recognized immediately, and the corridor approach is not used. Now let us see the termination and equity compensation benefit. That one will be the last part of IS 19, so that we can do a question. That will be the the two part. Then so that we finish the explanation of the theory part. So the three of them. So we are remaining with the termination benefit, equity compensation benefit, and the disclosure requirement. Now, for termination benefit, this includes the lump sum payments or the enhanced retirement benefit or other post-employment benefit and salaries paid until the end of a specific period, even though no service is rendered by the related employee. That one is correct. So that's what we mean by the word termination benefit. Now, IS-19 requires the entity to recognize a termination benefit as a provincial. So in case they ask you, you explain the recognition of termination benefit. You say that IS-19 requires the recognition of termination benefit as a provincial. Now, it will be recognized as an expense immediately when it becomes demonstrably committed to the termination. So an entity shall recognize the termination benefit as termination benefit as an expense if it is committed to termination. If all the benefit fall due more than 12 months, it must be discounted back to present value. You need to know that one. So any benefit which exits 12 months or more, it must be discounted. Let's go to the equity compensation benefits as our last part of types. Now they include the shares, share options, or any other instrument issued to the employee um, uh, less at a price which is less than the fair value, at a price which is less than the fair value at which they are issued to the third party, at which they are issued to the third party. So when we talk about the equity compensation, is where an employee is issued shares or shares options at a price which is less than the fair value in comparison to what the entity issued to a third party. So it must be less than that amount. Or it can be also in form of cash payment amount, which depends on future market value. So it could be also in form of cash payment, but that cash payment depends on the future market value of the entity shares. Now, IS-19 does not require any disclosure or recognition requirement for the equity compensation benefit. So, in case they ask you an exam, explain the recognition, explain the measurement and recognition of the equity compensation benefit from the IS-19. You just say that IS-19 does not require or does not deal with the recognition or the measurement of the equity compensation benefit. Disclosure requirement. Now, disclosure, an entity shall disclose the amount which is recognized as an expense in the income statement. So that is number one. Number two, no disclosure requirement is required for specific. Required here is the word specific benefits, but an extensive disclosure must be provided. Not specific, but an extensive for the long term or the post employment benefit plan. Also, the IS-19 does not require disclosure of specific requirement of equity compensation benefit, but it requires an extensive disclosure requirement. So that's all about the theory part. I want us to do a question for April 2024, number 4B. April 2024. Question number 4B. April 2024. Question number 4B. April 2024. Question number 4, boy. Question number 4, boy. That one I'm going to do it together. And then I'll give you another one to check on your side. And then that will be the end of this topic. Thank you. Now, April 2024, question number 4B. Let me read the question. The question says, Mazuri Benefit Scheme is a registered scheme and trustee of the scheme extracted the trustee of the scheme extracted the following trial balance as at 30th September 2023. So we have the trial balance there. Then additional information number 1, interest on investment amounted to 24.5 million accrued as at 30th September 2023. Then you have a management expense of 450, which was a prepaid expense as at 30th September 2023. So we have an accrued income, and we have a prepayment expense. So required number 1, the statement of changes of net asset of the for the year ended 30th September 2023, and then statement of net asset as at 30th September 2023. So let us do that question together. So I will start with my Mazuri benefit scheme. Mazuri benefit plan. Statement of changes of net asset. Statement of changes in net asset. Statement of changes in net asset for the year ended. For the year ended 30th September 2023. So our amount is in million shillings, but it in million. So we start number 1 with the member contributions. So our members contribution is the last item, I think, which is to 50.2. So members contribution to 50.2. Then you look at the employer contribution. So employee contribution, we migrate with this one so that I can see it clearly. Okay, let me put it here so that I can see it clearly. So members contribution is 640, not 640. Employers, supposed to be employers. The first one is the employee contribution. We have the employers contribution 630.6. 630.6. Then you add so that you can get the total contribution. Total contribution of how much? 880.8. Then you are supposed to less the following amount. Number 1, we can see we have pension and computation. Pension and computation is an amount of 209. The last one, the last item. Pension and computation. Then you have withdrawals from scheme. Withdrawals from scheme. Withdrawals from the scheme Now the withdrawal from the scheme is 15. That is the second last. Withdraw from the scheme, and then we have we get the net addition. Net addition from the members. Net addition from members, which is 656.8. Then return on investment. Return on investment. So return on investment was 640. But remember, we had an additional information of how much. We had additional information of interest on investment, which was accrued income of 24.5. 24.5. So 640 plus 24.5, which is 664.5. So we are supposed to check on that, so that we have 1321.3. Now look, let's less other asset, less other expense. So there's the other normal expense. We have the management expense. Management expense. Now it had a working, so the management expense 7. Then we had an accrued, no, a prepayment expense of 450. So we convert it to million, so it will be 0.45. So it will go to 6.55. So we had a prepayment there, prepayment expense. Then after management, we don't have anything here, so we shall have net changes in asset. Net changes in net asset. How much changes in net asset? Let's say changes. Say changes in net asset of how much? So it 1321 minus that one will be equal to 1314.75. And then we add opening accumulated fund. So our opening accumulated fund is in our statement as 1st October 2022, 7640. 7640. So when you add them together, we shall get the closing net asset. Net asset as at 30th September 2023. So how much is that when we add 8954.75? Confirm with the calculator. That is part A. Let's go to part B. Part B requires us to compute. So this one is part A. Then you can do part B here. Mazuri benefit scheme. Mazuri benefit scheme. Statement of net asset. Statement of net asset as at 30th September 2023. As at 30th September 2023. Now we start with the PP, property, plant and equipment. Remember our amount is in million. So we start with this is our assets. So we start with the PP. So our PPE is 800 from the question. PPE is 800 million. Then after PPE, we have investment in quoted share as an asset. Investment in quoted shares. And we have investment in unquoted shares. All those are assets. Now from the question, investment in quoted shares is 2,500 and the other one is 3,000. The other one is 3,000. Once you are done with the investment, you have government security. Government security. Government security, how much? 590. And then we have offshore investment. Offshore investment. So offshore investment was let's go to our offshore investment. Where is it? 1,200. But remember, we had another investment of this one. This one is an investment which was from the question, it was an accrued investment. So an accrued investment or an accrued income is an asset. 24.5. So 24.5. Let me see. No, it's not supposed to be 24.5 actually. Let me check. Sorry, we have the interest on investment. So this investment attracted an interest. So we need to less an interest on investment of 160. So interest on investment is in the trial balance of 160. The second 1, 2, 3, 4, 5, 6. The sixth last, if that is the correct. So 1200 times minus 160, which is 1040. 1040. Then we have the accrued interest. This one of 24.5. So it was a accrued income. So accrued interest income. So accrued interest is asset. Then you have fixed deposit and current deposit. Fixed deposit as an asset and also current deposit. So fixed deposit is how much? Where is it? Fixed deposit 260, and that the other one is 32.2. 60 and 32.2. And then you have receivables from members. Receivables from members. Receivables are data from members. So the receivables from members is 635.6. 635.6. Then you have interest receivables. Interest receivables. Do we have the interest? Sorry. Let me go back. Yes, interest receivables. The first one is 80. We have interest receivables. The first item that will balance 80. I think that is all. Then when we add them together, we get the total assets. Total assets. Let us confirm the total assets together. It's supposed to be 8962.3. 8962.3. Let us see. 800 plus 2500 plus 3000 plus 590 plus 1040 plus 24.5 plus 260 plus 260 plus 32.2 plus 635.6 plus 80. So 8962.3 correct. And then now we are supposed to less liabilities. So now we less liabilities. And the liabilities that we have, number one is payables to members. Payables to members is a liability. Payables is a liability. Payables to member is 8. Then you had prepaid expense. Actually, prepaid expense is an income. It's an asset. prepaid expense, this one is an income, supposed to be an income. It's an income. So we have done a mistake here. So what we do, we need to add here prepaid expense of 0.45. 0.45. Then we get the total assets. So plus 0.45. 89 62.75. Now we less our payables. So the only payables that we have, it is only one item, which is 8. So that we get our net assets. We get net asset as at 30th September 2023. And that net asset must be the same as this one. Must be the same as this one, 8954.75. 8954.75. So let us less. We see if we can get it. It was supposed to be this amount. That one, 8954.75. So let us less and see. 8954.75. That is correct. So that's how you are supposed to do that question. So assignment, in case you don't manage to do it, you can ask for the solution. So assignment, the assignment is for the last sitting paper. That is April 2024. Let me confirm. So April 2025. April 2025. Yes. April 2025. Question number 4B. April 2025. So April 2025. Question number 4, boy. April 2025. Question number 4, boy. That one marks the end of our class. I think we can meet tomorrow for another class.